but Coforge has managed to sort of, I think, do even better. We got a subdued start, so it's about 23,100 on the Nifty, and the Nifty Bank is starting at about 48,640. So about a 0.25% lower on both the Nifty and the Nifty Bank at this point. The Sensex is down about 0.17%, and the Nifty IT index is up 1% right now. Look at the advanced decline. It's very early, but 500 up, 500 down. So stocks are still opening up. So we'll have to give it some time. The Nifty heat map in view now, and more down than up. So 35, 37 names are down, and the rest are starting in the green at this point in time. So 50 points lower, but holding on to 23,100, which of course the Nifty managed to cross in the last 20 minutes of trade. Surbhi.
Okay, so 58 down, that's how we're starting. Let's look at what's taking it lower. Lever, the disappointment. There's no growth. It's so anemic. And even that minimalist acquisition is not enough to sort of, brighten up the light over here. 3% down. There's also a Nestle, which is lower. Some of the big heavyweights, the big boys are starting lower. SBI, L&T, ICICI Bank, even Axis Bank. So basically, banks are not doing too good this morning. Let's see what HDFC Bank is doing, because the numbers were in line to moderately positive. I mean, no hiccups in asset quality. Margins were steady. Stocks up about 0.7%. But otherwise, it's a weak morning for the banks to start off with, and a weak morning for consumers. More names on the downside: NTPC, ONGC, BEL. So, some of these names from the PSU pack also lower. What is holding up is Ultratech Cement. There is some buying on Infosys, Wipro, and TCS. So basically tech. And like I mentioned, HDFC Bank. Apart from this, there's not much to write home about right now. Nifty under pressure. 50 points gone, 23,100. Nigel?
Well, a few stocks actually are coming in for a hard knock. DAM Capital, I think it's corrected now all the way to that IPO price. So big correction from the recent peak is what we've seen on DAM Capital. That one's come in lower. You have KPI Green as well. That's down another 4.5% or thereabouts. Post that corporate action, the stock has only moved one way, which is down. HUL has given up those gains right now. What's doing well though? Go Digit. Well, that stock is flying away. That's up close to around 4% as we speak, on a very, very good volume. So good going on that one. Your Coforge is doing well, and Signity as well, now owned by them. So that one as well is up close to around 5%. The one that's taking it on the chin is Puravankara. Big downtick is what we're seeing on that name. So just keep an eye out on that stock as well as we speak. Well, yes, now it's down close to around 8%, and volumes as well, not too large actually. So we'll have to wait by to see whether or not it's, it could see a bit of a recovery from year on. But flattish start with a mild negative bias. Midcap index is still in the green, and I think the bulls will like that. Pidilite is another stock I think that it opened up in the green with a gain of around 1.5% to 2%. Let's see what Pidilite is doing. I think the volume number was quite good. Now it's flying away, up close to around 5%. So big up move is what we're seeing on Pidilite.
No, absolutely, and it's actually 1:1 advance to decline ratio, and 1,000 odd stocks with actually 900 up and about 1,100 lower, but broadly 1:1. So one space which got beaten up pretty badly recently is all the EMS companies. So this morning there is some recovery. Keynes is up 3%, 4%. So stocks at about 55.50. Amber is up about 3.5 odd percent. And we should look at the leader, Dixon, as well, if there is anything there. So these are EMS names which have been under severe selling pressure. 0.5% on Dixon, not very much right now. I think the result reactions we all, covered. Coforge, Persistent, and Pidilite are number 1, number 2, number 3 in terms of volume traded gainers right now. Go Digit, I think, is another one. Earnings 4% higher, and we mentioned that. Ultratech is coming up with some gains, 2% so far this morning. And decent sized volumes as well. Doesn't usually show up out there. Oracle Financial Services 2.5%, and it's got volumes right now. Another one which has gotten sold quite aggressively is Motilal Oswal. So that's up about 2%, and it's got decent sized volumes. Look at Indigo. Indigo again, I mean, huge selling from 4,700 to 4,000 very quickly last 15 days or so. So seeing some gains, 1.6 higher. And again, another name which got sold aggressively is Aurobindo. It's recovered quite nicely. The low today is about 11.97. It's recovered about 15 to 16 rupees already this morning. It's all a story of recoveries, right? K Fintech, for example, sold off from 1,600 to 1,000 rupees. It's coming up a little bit. KEI, we spoke with the management yesterday. The low yesterday was about 3,900. Stocks at about 42.50 now. So there is enough and more in terms of specific stock-specific action which is going on at this point. Tata Com, we spoke with the management. Stocks down about 2%, 2.25%. So that's another one. 50 points all told on the Nifty with about three minutes of trading behind us. Yogesh Patil is Chief Investment Officer, Equity at LIC Mutual Fund with his take, his perspective. Yogesh, good to have you back on the program. What has the investment team and you been doing at the fund during the course of this correction? How much cash are you on? Just give us the basics first.
Good morning, everyone. See, normally we don't keep higher cash because we're getting money to invest it. But considering the market opportunities and India's long-term story, we continue to believe India is a very attractive opportunity. But its opportunity is available in raw form, and a lot of things has to be done by state government and government, central government. So there will be some lag in between whenever these capex program changes. But we continue to believe India is a long-term investment growth story, followed by again manufacturing and consumption. And if you see the last decade, the consumption played a bigger role and lesser investment. But we, at this point of if you see the manufacturing GV as a percentage of GDP is almost 14%, which is almost equal to commodity-driven countries like Brazil, Russia. And China is almost at 26, Korea is 24. So India need to increase gross block and India need to spend more and focus on manufacturing to reduce imports and improve the infrastructure so they can, most of the companies in India can be compete with global players. So this is a decadal story, and especially gross capital fiscal formation till date is roughly 93 lakh crore, and we do see a major portion from private and government capex basically through infrastructure investment like railway, defense, and new segments like data center, EMS. All these new things will continue to drive the India story in future, and followed by consumption parallelly, because consumption is suffering because of the poor real wages growth and salaries and lack of new job creation. So we think we are near to close to bottom at this stage, and government is also focusing on the rural. So this will again start reflecting over next 2 quarters.
Okay. All right, Yogesh. So, how is the portfolio position as we move to the budget? Would you rather look at maybe bigger positioning in capex stocks and PSU, railway, defense, or even private sector capex names, or would you rather look at staples, which have been beaten down quite badly, if indeed there is this hope for a rural push and a rural recovery?
Thank you. Our portfolio is completely aligned to our thought process. We continue to believe investment in infrastructure will continue to rise, and followed by capex from many private and PSUs, because this is a need of government is trying their level best, but unfortunately there would be some miscoordination between states, or maybe new segment of companies requires a different level of coordination. Like in previous cycle, we might seen a very high capex from, let's take a cement and thermal power plant or metals, but the new capex from private sector is completely different. Is more on asset turn side, like in capex from CDMO player, EMS or GC centers are very, very different, and this will give a very similar impact of GDP compared to last 20 years. And as a house, we continue to believe capex, and our portfolio is fairly aligned with capex stories from completely driven by power sector, data centers, railways, defense, PLI schemes, and other auto sectors companies.
What about consumption theme, Yogesh? You're getting split verdict out there. Some of these high pedigree, traditionally trading at very high multiples. Growth is not coming by, and commentary is rather subdued. At times, yes, this peak pessimism provides good entry opportunity. Has it reached that level?
I don't think valuations, we need to readjust the growth, because next 4 or 5 years the growth could be very limited, because it starts with manufacturing, infrastructure, and job creation. See, the job creation would be the trigger point for India for consumption, mass consumption especially.
Okay. That's the outlook on a couple of sectors. Just back to the market, it's still some of these mid-cap IT names which have had a better earnings performance. They're the ones that are looking better, but 6% up on persistence, actually 7% now. And Oracle Financial, Coforge, these are the names that are rebounding. In the next couple of minutes, we'll also have the management of BPCL joining in.
Coforge first.
Coforge first and then BPCL. But before we get to the rest of our corporate commentary, Yogesh, on IT, I mean, it's been very, very mixed trends. Larger companies are still struggling to showcase big growth, but mid-cap names are doing, a lot better. Do you like anything here? Either, traditional IT, or let's expand that further. There are internet companies that have gone through a fair amount of price correction as well, platform companies. Would you buy into the weakness?
See, definitely, we need to see the valuation and the growth prospects. As of now, if we see last 3 quarters, majority of the companies have not given any negative shock. And the commentary has been positive with a low cancellation of projects and fairly positive side on discretionary and BFSI. And after the President Trump, I think there is no major hurdle at this point of time. It's just a valuation where investors need to choose. And at the same time, AI, there are new themes in IT also, AI, but again, it is a company-specific stories. Even forget about IT, every sector is a completely different, company-specific, segment-specific. So we are very selected in IT firms, especially between large and mids. And where we see a disappointment from earning, definitely we need to relook that story. And coming back to your platform, see, platform business is very, very different and very highly competitive. And at this point of time, because of the too much of noise, we are avoiding those segments.
No, I take the point. Just a few other names which are moving around that we want to highlight. Yesterday was a big mover in Jana Small Finance, right? I think it ended up about 20% higher. It's down about 3% this morning. So 424 on JSFB. Oil India is down about 2%, and there is HPCL, which is down about 2.5–3% as well at this point in time. India Mart has been, of course, up and down, but it's down 3% now. So big decline after results for India Mart. Nestle is starting about 1.7% lower. KEC is down about 3%. Very sharp fall on KEC. Recently, last week, maybe end of the week before, was at about 1250. Stocks at about 860 now, KEC. So, a fair bit has moved around. PNB Housing, we had the management with us, 2%, 2.25% lower. And unfortunately, if you look at the market breadth, if you look at the NSE advanced decline ratio, it's now 2:1 in favor of declines. It was running 1:1 for the broader market, and it was looking like, it was a little better, but not anymore. Of course, on the flip side, you've got all these, you've got Kalyan Jewelers, which is up 2% or so after the battering it's gotten. So it's coming up with very large volumes this point in time. And I mentioned the EMS names, which are all looking a little better. Maybe put up Swiggy as well, 2.7, 2.8 higher. And I can't spot Zomato, at least not on this list with volumes, but that's got some action and activity as well. Yogesh, we leave it there for now this morning. Thank you very much. Really appreciate your time here on CNBC TV18. Thank you for being here. Well, let's talk about, HUL and Pidilite, the FMCG majors, and revisit the implications for the stocks, but also, of course, these are, in a way, they provide signal for their respective sectors. Mangalam is here. Mangalam.
Well, it's a tale of two cities, right? Both results were largely in line, but in HUL's case, the expectations were very muted. And in Pidilite's case, the expectations were slightly elevated as well. So if you look at HUL, the net profit was boosted by a 500 crore one-off that came in, but nothing really to write home about when it came to the numbers. The revenues grew just about 1%. The EBITDA grew by about 1.5%. That's what the street was anticipating. Margins largely between that 23 and 24% mark. 23.2% was the company reported, and the net profit boosted by the one-off gain on Pureit sale itself. Volumes were absolutely flat, and it's not that there was any unfavorable base or anything. Over the last 7 or 8 quarters, the volumes have been middling between 2 to 3% itself. And if you look at the segments out there as well, home care grew about 5.4%. The street was working with a number of 2 to 3%. But besides that, all the other segments, personal care, foods and refreshments, as well as beauty and wellness, all of them underperformed street's expectations. The company has made an announcement where they will acquire 90.5% stake in Minimalist for about 3,000 odd crores. It's an annual revenue run rate of over 500 crores. They're essentially buying the brand, the positioning and the customers of this business. But then again, the stock had corrected about 22% from its highs, trading at lower than historic valuations. But until growth does come by, it looks unlikely that the street is looking at HUL favorably. On the other hand, Pidilite, there is subdued demand across both urban and rural geographies. The company's stepped up ad spends, and amidst that, they've reported revenues slightly above street expectations at 3369 crores. EBITDA also around that 800 crores. Yes, the margins did come off, but the street's expectations here were slightly elevated. The company's own guidance has been between 20 to 24% itself. And as a result of which, in a weak environment, the company's reported revenue growth of 7.5%, EBITDA growth of a similar amount as well, and a net profit growth of 9%. The total volume growth this time around came in at 9.7%, led by 7% consumer volume growth and 21% B2B volume growth as well. The other thing that works in the favor of Pidilite is that those who want to play the building products theme, are now split between paints and Pidilite. The paint sector has challenges of its own with regards to competition, etc. So that gives a clear run to Pidilite for investor capital as well, as there is not as much competition in adhesives, and VAM prices are continuously lower as against crude prices as well.
All right, Mangalam, thank you very much for that. So that is the picture on FMCG. Tale of two cities, as Mangalam said, for our viewers. Well, we got the market, which is down about 40 points. 23,100 is where we are trading at now. Well, Coforge is the stock of the morning by far, right? I mean, it's reacting to very strong third quarter numbers. And remember, this is a beat on what were already stronger expectations. If you sort of compare expectations going into the earnings season, Coforge and Persistent were right on top in terms of the growth expectations. So and of course, Coforge more so has beaten that. Let's talk to Sudhir Singh, CEO and Executive Director at Coforge, who's with us now to tell us what next. Sudhir, good morning. Great to have you with us here post every quarter as always. And you kind of told us after second quarter what next. You said you called it as a very strong F525. You said Q2 was an aberration. Q3 is going to be extremely strong. It's all panning out exactly like that. 9-month revenue growth is 27.1% dollar revenue growth. Just tell us a little bit what went into the mix. Just the most important two or three things. What went into the results and what should we expect now for 27? For FY25, beg your pardon. Go on.
I think the not just the quarter to come, but even the next year promises to be extremely solid because of a few things that have already been locked in through the year. You noted the YTD growth at 27+%. More importantly, from our vantage, in this quarter, which is a seasonally short quarter, we've already signed 4 large deals. Importantly, the signed order book over the next 12 months is already $1.37 billion, and that's more than 40% higher than where that metric was a year back. So going forward, given the pipeline that we have, given the large deals that we recently signed, given the signed order book, and given how the margins have been trending extremely positively and aggressively upwards, even sequentially, we continue to feel exactly in line with what I told you at the end of the second quarter. The year to come appears to be a year that will have sustained, robust, and very solid growth.
So these are better than 25, just in terms of growth rates?
We don't give a guidance, unfortunately, so I can't share that number with you. But for now, I just qualify that as very robust growth, profitable growth. And for a firm that's now been growing for 8 years on a very sustained basis, sustained growth into the 9th year as well.
Sudhir, hi, morning. Can you just break up the trajectory in terms of how strong the organic growth is and how well the recent acquisitions are sort of playing along? Signatory, for instance, I know the margins have come in, I think, above 17% now. So what is the breakup? And going forward, while you're saying the next year is going to be bigger, I mean, just walk us through whether it will mean more in terms of margin expansion or whether it will be just sustained top line action. I think you're at 25% dollar revenue growth so far, 9 months in the current fiscal year. So just give us the breakup, organic, inorganic, and what to expect going forward.
Sure. Let me break the numbers down for you. The non-Signity business sequentially in the quarter has grown 9.4%, and Signity has grown 3.5%. They also had that business had a solid quarter. The non-Signity business, which is the organic business that you're talking about, has grown 9.4%. So it's had an absolutely exceptional growth quarter from our vantage. Though that's the breakup of the numbers. And as I say, we would expect growth to be robust across the firm and across both the Signity and the non-Signity portfolios on a go-forward basis.
Hi, Sudhir. Congratulations. Solid set of numbers, and your commentary as well is pretty good. Give us an updated timeline then. I recall you telling us that you'll be going to $2 billion of revenues and margin expansion of 150 to around 200 basis points. By when?
We've never really put a hard quarter timeline to it, but the key metric that I would like to point out is that in 7 quarters, the revenue run rate of the firm has gone from 1 billion to 1.6 billion.
Right.
It's taken us just 7 quarters to grow 60%. I suspect 2 billion is not too far off, reflecting back on the trajectory that we've already plotted out, the pipeline that I referred to, the signed order book that we have. Can't put a quarter number to it, unfortunately, publicly at this point in time, but we have very clear plans. We have very aggressive plans, and our confidence, as I suspect you've seen from my tone, is sky high.
So, Sudhir, that run rate, could you hit it towards the end of FY26? You know, some were expecting it by FY27, but towards the end of FY26, you don't rule it out that you could get to the $2 billion run rate?
Our attempt will be to hit it at the earliest possible. Our track record, which I've talked about, 60% growth in 7 quarters would attest to the fact that we are hungry, we are capable, and we are just about as committed as any team can be. So the intent is to get to it at the fastest possible clip here on.
Oh, absolutely. Well, the market is definitely noting your tone, Sudhir. The stock's flying almost 10% higher, and it's not just the tone, it's the numbers that are absolutely matching up. So we've discussed a lot of the numbers. I just want to understand slightly qualitatively, maybe in 40 seconds, what are these new clients telling you? The sign-ons have been very, very strong as well in the past quarter. Which are the segments that are firing? Which are the geographies that are firing? Because you're definitely doing something very different in an environment where a lot of the bigger players are struggling with, anemic single-digit growth, of course, on a very large base. But just trying to understand, what is the niche that you will go after in the next couple of quarters to sustain the 60% sort of growth rate?
The 40-second clip would be as follows. Travel revenue passenger kilometers for airlines is expected to grow 7%, which is a huge demand outlook for the airline sector, given the nature of that sector. We therefore expect to ride the personalization wave. We expect to ride the digital mall creation out of airports wave. We expect to ride the AI-based customization wave. That's travel. Insurance SMB space, the need for legacy modernization driven off platforms like a Duck Creek, Guidewire, Majesco is extremely strong. And the emerging trend is to ally that with no-code, low-code platforms. That's a sweet spot for us. We intend to ride that. Banking, operational resiliency, regulatory compliance are areas where spends continue to be strong. That's an area that we've always been very good at. And that's a third wave that we expect to rise. That would be the 40-second clip for you.
Okay, helps. Thank you.
It's like an arrow locked into the target. But jokes aside, I mean, it's executed extremely well. And of course, it's for everyone to see. This entire AI infrastructure boom that we're seeing in the US, I mean, do you kind of sort of play in some way into all of that? Or you don't need to, you're doing well without, but just asking you that.
No, we very much play into it, and that's one of the contributors to the kind of growth rates that you commented on right now. We are increasingly seeing that the conversations around AI are pivoting more towards data-first conversations. So the conversations are increasingly around scalable data pipeline creation, which is where we are helping our clients. They are increasingly around vectorization or infrastructure build for AI model training and deployment, which is again an area that we play in. And obviously, since AI operates as a diagonal and not a horizontal for us, it is straddling all the HPUs and every horizontal offering that we have. So AI clearly is a space that's of vital importance to us. We've been locked in it like an arrow, to use your words. And that's an area which we expect to infuse just about every solution that we construct for our clients on a go-forward basis.
Okay. I mean, you send the stock up 10%, Sudhir. So, I mean, not you, but the results. And of course, behind the results, you and your team.
Locked.
So, it is locked. The 9,050 on Coforge. We have more questions, but no time. Thank you very much for joining us this morning. Appreciate it on CNBC-TV18 as always, and look forward to our next chat. I think what we'll do is we'll take a quick commercial break here. We'll come back and we'll look at the market as well. So we were down 50, we are up 30. So there is a little bit of recovery which is set in on the index. We'll look at individual stocks, etc. The BPCL management conversation also coming up on the other side.
Welcome back. Well, the market is continuing to chug along. Right now, the Nifty is just about 26 points higher. The next company on our radar is BPCL. Let's look at how the stock is doing. It's actually sold off a little bit this morning, down about 0.7%. Now, BPCL, of course, reported Q3 numbers yesterday, and the earnings were slightly below estimates. The gross refining margin came in lower than expected, and there were some inventory losses as well, which the market wasn't expecting, and therefore the disappointment. Plus, there's the issue of under-recoveries in the LPG segment. So what's the way forward? Well, we have with us Mr. G. Krishna Kumar, Chairman and Managing Director at BPCL, joining in. Mr. Kumar, thank you so much for being with us this morning, sir. So before we dive into your performance and the earnings, I want to ask the other bigger question, the whole geopolitical question, which everyone's trying to understand. These sanctions on Russian entities, Russian ships, Russian oil companies, do they limit our capacity to buy oil from Russia in any way? And the minister, I think just yesterday, made the statement that yes, India's imports from US, crude oil imports, could perhaps increase. And that's, we're in a very dynamically changing world order when it comes to the oil markets. So that first, and whether this change in the mix is going to impact your operations in terms of crude between Russia, Saudi, and maybe more from the US now.
Thank you for having me on the show. It's very early days. Actually, we are assessing the situation on the impact of the Russian sanctions. But having said that, we can be very clear, there will be a slight short-term impact for about a month or two. But we are looking at rebalancing the whole crude purchase. We will look at more of Middle East crude and the US. And with Mr. Trump saying that he's going to free the energy and there's going to be a lot of drilling, I don't think there will be a shortage of crude in the near term. But there will be a slight premium we'll have to pay, and that we can always rebalance. And over the year, it will balance out. So and in the short term, yes, there will be some cargoes which will be, there will be shortages of some cargoes because of the shipping. Shipping will be a problem. But over the next 2 months, I think that all that will be sorted out.
So when you say that eventually we'll have to move, we'll have to source more from Saudi Arabia in the short term and maybe more from the US, and you say that will come at a premium, can you just tell us, I mean, roughly speaking, what is the higher premium? Because, I mean, just logistics, right? The shipping costs, I'm imagining for starters, is going to be much higher getting in that oil from the US.
There are two things, okay? One is that right now we are in the spot market. We don't have a term agreement as yet with any of these guys. So because there will be an upside because of the sanction. the premium will be around the range of, we hope, around the range of $2 or $3. But we are looking at also delivered supplies from different countries. So that should eventually eventually pan out the numbers. Initially, there will be a difference about $2, but I think that will pan out.
Okay. Hi, good morning, sir. If you could help us out with crude being sourced for Russia as a percentage of your mix, what is it roughly?
So far, it was about 35% of our mix was from Russia. And
35%.
the rest, 35%.
Okay, all right, interesting. You know, I ask you this in the backdrop that the last quarter's GRM was a little lower than what the street was working with. So could you give us a rationale behind that? Because it came in at around 5.6. The GRM, sir. The GRM came in.
If you look at the Q2 GRM, it was about 4.41, and Q3
Indeed.
actually we have done better. We have actually done better at 5.60. The whole situation was very volatile. If you look at, there were tightening of the Russian crude, tightening of the discount, and also we had our planned shutdown programs in Kochi and Bombay refineries. This slightly, and moreover, the cracks were lower comparatively. So all put together, there was a tightness in the whole situation. But having said that, we've still done better than Q2. And going forward, we are very confident that our refineries will perform well. If you look at it, last whole year, our GRMs were best among the industries.
Yeah, that's right, sir. You know, I'm taking that point on board, and you've given me rationale because the GRM improved on a quarter-to-quarter basis, which is good. But only in comparison to what the market was estimating, it was a little bit lower. But as you're putting those points, that because of a couple of reasons, it was lower. What's the trajectory with regard to GRM from here on? If you could help us out with the number.
We should end the year, because the next 2 months are going to be a little tricky, because we don't know how the crude will actually pan out. Though we feel that there won't be much of an impact. There will be an immediate rebalancing of crude. We hope to be around 6.5 barrel per barrel.
Okay, all right. And
that's our estimate.
All right, fair enough. So $6.50 per barrel is the GRM estimate for you, right, Mr. Kumar? Good morning, sir.
Yes.
You know, with regards to these LPG under recoveries, Mr. Kumar, could you give us a sense of what would you expect on that front? What's the quantum for BPCL, and will this come in by March?
See, we are very hopeful. Last year, the government had supported us with a subsidy of about 5,000 crores. And we are very hopeful that this year too, they will support us in time. So we do not know exactly when it will come, but we are hopeful that it will come by March.
And what is the under recovery for BPCL so far?
It's about 7,200 odd crores, which you have put also on the screen, but that's the kind of numbers for LPG just now.
And you think you would be compensated to the full extent, or I mean, any signal from the government in that sense?
I'm not sure it will be the full extent. As much as possible, I think they will give us. The rest we'll have to take it.
Sir, there is this talk about an IPO of an entity where you're one of the joint venture partners. This Maharashtra Natural Gas, and there are large distributor in Pune, I believe. Any updates on this? I mean, have the JV partners discussed this? What are the timelines?
See, we have a joint venture with GAIL India for MNGL. We have, as our board has approved the proposal, as you understand, that both the joint venture partners have to get their approvals in the board, and then we have to get the approval of DIPAM. That is the standard process for doing an IPO. So we've got our approval. We hope GAIL will also be done. So probably in the next 4 to 5 months, this should be through.
Okay.
Okay. Mr. Kumar, another point which some are a little worried about is what you've announced in terms of new projects, right? There is one Petchem 2 million ton plus Petchem project in Bina, another one in Kochi. Are all these on track, sir? And if you could just talk us through what are timelines looking like here?
Yeah, okay. So we have two projects. We've announced two projects. One is at a 2 million ethylene cracker plant at Bina, along with the expansion from 7.8 million metric ton of the refinery to 11 million metric tons. We have a project size of about 48,000 crore, that includes GST component. That's expected to be commissioned by May of 28, and that's on track so far. Okay, and we have just done a financial closure with SBI as the lead banker and a consortium of banks for about 31,800 crores. The financial closure is done, and we are very confident of this being on track. The feed and the engineering part of the component is over. The licenses have been selected. So we are now looking at a closure. Our execution is our strongest focus right now. Likewise, in Kochi, a 5,000 crore polypropylene plant is being commissioned. We are very confident of that project coming before time. We are expected that to be sometime in July of 27. We're expecting now closure around April of 27.
And finally, sir, I think the marketing side of the business has done really well, right? Marketing margins have been quite good. And we've seen crude oil prices come down, and now there's talk of lesser wars in the world and more crude oil, more drilling in the US. So maybe crude remains benign. Can you leave us with an expectation on the marketing side of the business? What level of margin are you at? Where will it sustain? And I don't know, I mean, as a consumer, we can only ask, if crude comes down further, would you be passing that on to the customer, or would you be retaining some of the margin cushion?
We'll have to look at it as and when the crude moves up or down. But we are very confident on marketing. We're one of the strongest networks in the country. We have about 22,000 stations outlet. We're coming out with a bouquet of energy stations where, apart from petrol and diesel, we'll also be offering CNG and EV chargings. And along with EV charging, we have come with a new proposition in few select outlets now, which was on a pilot basis called B Cafe, where we have created a very good experience Shell coffee station, where when the person's charge the EV, which is about 20 to 25 minutes, even if a two-wheeler, he'll have to charge for 20 to 25 minutes, he can be engaged in this coffee shop. And this coffee shop is entirely sourced by BPCL. We have not taken any outside help. So and that's branded as B Cafe. You can see on some of the highways. So and we're very confident that marketing will do very well in the years to come.
I can't wait to try coffee at one of these B cafes, sir. As a self-confessed coffee lover, sounds like a very interesting and exciting proposition. So we look forward to experiencing some of that. Thank you so much for joining us and giving us a well-rounded view on all parts of your business. Thanks very much for joining in.
Thank you so much.
Okay, thank you. Well, with that, let's quickly move on. It is time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, we have Nigel on the wall because he is going to tell us about what the third quarter could mean for the metal sector and metal players. Nigel, over to you.
Well, quarter 3 FY25 is traditionally a stronger quarter, and normally we see that quarter 3 is better than quarter 2 for various companies. We see normally a recovery in pricing as well as in volumes. That's what we normally see in the third quarter. However, this time around, we saw a recovery in volumes by approximately 1 to around 5%. But increased Chinese imports as well as falling global steel prices, they have impacted blended realizations by roughly around 1,000 to around 2,000, 2,500 or thereabouts. But there is a discrepancy because longs, they have performed better than flats. Average realizations have fallen by close to around 6%, while for longs, it's improved by roughly around 1.5% to around 2%. And this is the deciding factor for better profitability of long, heavy focused companies like JSPL. While other companies, well, they have higher flat exposure, and so the EBITDA per ton will be under pressure. But for JSPL, in fact, it'll actually be a little bit higher on a sequential basis. Now, the cost of production fall was insufficient to cover the realization hit. The coking coal cost will fall by roughly around $15 to around $20 per ton for most companies. But the iron ore cost is expected to increase by around 300 to around 350 rupees per ton. Higher iron ore cost means that the non-integrated players, they will relatively underperform. By the overall integrated players, they'll see a better performance on the iron ore front. Companies like Tata Steel and SAIL, they're fully backward integrated on iron ore. On the non-ferrous side, higher LME prices, they will uplift performance as aluminum and zinc prices, they've seen a sharp recovery on a sequential basis. Though lead as well as crude, they're a little bit lower on a sequential basis. What further supports them is the rupee has depreciated, and that's normally good for metal companies. Overall, margins for non-integrated players will improve as the cost of production is expected to remain flattish while the LME prices have moved up. Novelis, well, they may see the weakest performance due to the host of factors, but the street believes that maybe this bad news of Novelis will be a bottoming out process in Q3, and from Q4 onwards, Novelis's EBITDA per ton will improve. Well, let's wind it down with the valuation snapshot. As we can see, SAIL, it's the cheapest among ferrous players, and that's been the case for very long. While from the non-ferrous names, Vedanta is going to be important to track. Valuation-wise, is cheaper, and also it has a demerger tailwind. So we'll keep an eye out on that one.
All right, Nigel, thank you very much for that. So that's the expectations from the metals space. We have Aditya Velekar, Senior Research Analyst, Metals at Axis Securities now, joining in with what he sort of would like, what he's expecting really from the sector and what the implications for stocks, etc. could be. Aditya, good morning. Good to have you with us here. Prashant this side. Thank you for your time. You heard Nigel put out expectations in detail. What stands out for you? Let's just first break it up between ferrous and non-ferrous, and what are broad thoughts on for both in the quarter?
Yeah, good morning, Prashant. So ferrous definitely, as Nigel pointed out, is slightly weaker than non-ferrous. So we expect EBITDA per ton contraction in this quarter by 1,000 to 2,000 rupees per ton for each of the players. But as Nigel pointed out, we expect some sequential recovery in EBITDA per ton for players which have higher long steel exposure like JSPL and SAIL. This is because HRC prices are impacted more in this quarter because of the Chinese cheaper imports, while long products like which are used in construction activity, they are not impacted much. That is the reason why players like JSPL and SAIL will perform better. But if you take an overall view and look forward, going forward, the key triggers will be more important. So number one will be any announcement on the safeguard duty, 25% imposition of safeguard duty is expected. That is what steel players have demanded from the government. So that is one trigger. Next is any further stimulus from China. So as of now, the valuations are palatable for steel companies, but the growth triggers are lacking. So that is a view on ferrous. For non-ferrous, like aluminium companies, Hindalco, Nalco, and Vedanta, all the three are expected to do well in this quarter. EBITDA margin expansion is expected on a year-on-year basis. Sequentially, the margins might decline for Hindalco because of the weak show at Novelis, because of the scrap spreads falling in Novelis. Going forward, for non-ferrous metals, the aluminium outlook is still strong. Despite the dollar strengthening, the aluminium prices have sustained about $2,500 per ton. There are 2-3 reasons. Number one is that the demand in China has seen a slight uptick post-September stimulus. Then with the export tax rebate which China has removed, that has found some support to aluminium prices. And there is some talks about that the EU will sanction Russian aluminium. So all these things are supporting aluminium prices, and going forward, we see non-ferrous as a pack is better than ferrous. And the growth drivers, if the aluminium prices sustain around this level, then with the kind of projects Hindalco and Vedanta have, these two companies will stand out in our. These two companies screens out based in our pecking order.
All right, between the two, Aditya, what do you like though? Because Hindalco, the problem is Novelis's numbers are going to be weak. But, from the time they put out that provisional number, the stock, in fact, is higher. That's telling you that all of you all on the street, well, you all have already factored in the weak showing. And that's why the street is willing to look ahead. While Vedanta, that as well has not really performed, anything that's special. Because we saw the stock run away. And it's given dividend, yes, but it's not moved much. Now you have a special situation that's playing out there. So between Vedanta, Hindalco and Nalco, what is your preference?
Yeah, Nigel, to answer your question straight, I guess Vedanta will be our first picking in the picking order, followed by Hindalco and then Nalco. Vedanta, I guess, the number one tailwind is the demerger, and then their aluminium expansion is happening. The alumina prices which have peaked out will support them in Q4 onwards, and alumina prices are expected to slightly lower. Is expected to come down from this recent peak, which will be supportive for Vedanta. The rupee depreciation will also be helpful for Vedanta. Then the overall restructuring of the debt which they have done, and the target of deleveraging, and of course this demerger. So from that perspective, the valuation is slightly better vis-a-vis Hindalco and Nalco. For Hindalco, the issue is with Novelis spreads. We really have to see how they manage this particular challenge, because Novelis is dependent on scrap, and if the China scrambles for scrap, then this tightness in the scrap market should continue. So apart from their Indian business, which is really strong, and the kind of projects they will plan in India, that is a very key positive for the stock. But Novelis is kind of where the visibility is slightly muted. So that is why we are placing Hindalco as a number 2. Nalco is also good. It has a good alumina exposure. But the alumina refinery expansion, that should happen on time. That is one concern. And then the smelter capacity is slightly capped, and the smelter expansion is not really visible as of now. So that's why it is number 3 in our list.
Okay, all right, Aditya, thanks a lot for joining in and giving us all of those details. By the way, the Nifty has moved up. We're up close to around 40 points as we speak, holding at around 23,200. Slip into a short break. You come back, we'll get at some technical trades. Mitesh is waiting for us, and Manisha Gupta will give us an update in terms of what's going on the commodity space. Stay with us.
Welcome back. Let's go back and revisit the market, which has managed to actually bounce up quite nicely. We've got some green even on the mid-cap screen now. The Nifty is at the morning high. So let's go across to Mitesh and discuss some trading ideas. Mitesh, just an advice on the index as well, in case you'll trade either Nifty, Bank Nifty, and of course stocks.
Yeah. So I think, the both the indices look good, though it's the Nifty IT, which is clearly, having more traction today. But I think the Bank Nifty 48,770, and we're about 40 points away from that. I think that's the pivot. Once we cross that, expect the Bank Nifty to head towards maybe 49,150, 200 zone. So I think maybe on the Bank Nifty above 48,780, 790 zones, you might want to take a long with a 150 point kind of a stop. That's for another 400 point kind of rally. So that's the way we are approaching it. On the stock side, as I said, technology is looking good. So Tech Mahindra has come on my radar. Recommend a buy here. Keep a stop below levels of 1690. Look for a target of 1755 to about 1760. In a good case scenario, even 1780. And the other one which I have on my list is Pharma. Sun Pharma, I think, is looking good as well. Reversing after a good correction. So Sun Pharma is a buy with a stop below 1800 for targets of 1860.
All right, Mitesh, thank you very much for that. So those are specific trades. Well, Persistent is up sharply in trade in the back of very good numbers. You heard from the Coforge management earlier, but let's put this spotlight on Persistent as well with Rima. Rima, over to you.
Thanks so much for that. So Persistent stock surges on very strong growth prospects, strong delivery, good execution in Q3 despite high valuations. This is a stock which is up 50% in the last 1 year and 180% plus in the last 3 years. And it's also one of the most expensive IT stocks, trading at 50 times FY26 PE and more than 40 times FY27 PE. But investors continue to buy Persistent despite the high valuation because the company continues to deliver on growth. Look at the growth rates for the company over the past couple of quarters when things have been challenging for the rest of the industry. They've pretty much averaged a near 5% top line growth in the last couple of quarters, and even in this quarter, which is seasonally a tough quarter. And this comes on the back of many good years for Persistent. So FY24, which for large cap IT companies, was like a low single digit kind of a top line growth for Persistent. They managed a 14.5% growth. The prior 2 years, which were the post-COVID boom, the digital transformation surge, this company saw a growth of about 35%. And not just that, the company is guiding that growth will continue. So they're holding on to their $2 billion revenue aspiration by FY27 with margin expansion of 200 to 300 basis points. But they're now also calling out a $5 billion top line by FY31. On the quick word on the brokerage reviews, many like it, some don't. They admit the growth is strong, but valuations are too rich for comfort. So Nomura has a neutral rating on the stock. Nuvama and JP Morgan are very bullish. JP Morgan has raised the target price to 7,200, scaling new heights. Buy on dips is how they title their report. But Kotak and Citi, on the other hand, are not convinced given the rich premium valuations. Back to you.
Okay, all right, got it. Thanks very much. Rima's a good morning, actually, for a couple of these mid-cap IT stocks. Let's now shift focus to the commodity segment. We have Manisha joining in. Manisha, good morning. So what's grabbing your attention this morning?
Well, there's a couple of declines really in the commodity as a space. Remember, energy has continued to decline, and similar is the case with metals also, where we are headed for perhaps a week for this one. We are looking at dollar index stabilizing at around 108 now. It has seen a range of 107.5 to 110 on the higher side. The second factor to watch is tariff threats now coming in from the US president for various countries, not just Canada and Mexico, but also China and European Union, where there is also a trade deficit when you look at from US markets, and there have been statements to that effect. US Fed meeting on 29th of January is going to be on focus, not because there's going to be a rate change, but because there could be some guidance and statements that could come in from US Fed. And then apart from that, there also is a lot of caution in the international markets ahead of the Lunar New Year holiday in China. Whether or not there will be restocking ahead of that will tell you on where the metal prices are going. So when you look at the specifics here, we have seen the copper prices continue to decline. It has seen another decline of 1% in the overnight markets. Aluminum prices have come sharply off from its 2-month highs that we saw on 20th of January. And the steel rebar prices fell another 0.5% overnight. So whether you see it on a week-on-week basis, month-on-month basis, YTD, we are looking at decline in many of these ferrous metal prices. That's exactly what I want to put it on your screens right now. So when you look at this week, we are looking at most of these metals actually going in for a decline. Copper is down by 4%, aluminum 0.5%, 0.5% of a decline also coming in for zinc. But when you look look at the YTD basis, we still are holding firm for many of these metals. That is, the street believes that you could be looking at strong demand going forward. The dollar will see a decline, and a tariff increase would actually mean more expensive metals going forward. So copper continues to outperform. We also are looking at stronger gains for aluminum, but the best of the gains clearly are coming in for gold and silver on a YTD basis, and gold has continued to gain on a weekly and on a YTD basis as well. So the safe haven buying clearly coming in for that one.
All right, Manisha, thank you very much for that. So that's commodities in focus. Well, we'll take a quick commercial break here. The market, I think, is recovered from the day's low. We're up about 70, which means it's almost about 150-odd point recovery from the day's low, the morning low, really. On the other side, it's budget countdown, budget 2025. What will it hold? Lata will be in conversation with Goldman Sachs and HSBC economists on exactly that. What will be the policy thrusts? Coming up in 2 minutes.
Welcome to our budget countdown special. Today we discuss the macros. The earnings so far, corporate earnings so far, especially FMCG companies, is casting fresh doubts on whether the economy really bounced back in the third quarter from the second quarter lows of, 5.4%. So should we expect a budget that will recognize this slowdown and indulge in more subsidies or income transfers? Will the trend of rising capex by the government plateau or even fall? What kind of nominal GDP growth and tax growth or tax buoyancy should we assume? And above all, will it continue to aggressively cut the fiscal deficit, the government that is? For all these questions, I'm joined by two top-of-the-rung economists, Shantanu Sengupta of Goldman Sachs and Pranjul Bhandari of HSBC. Pranjul, of course, joins me in the studio. Thank you very much, Pranjul and Shantanu, for joining. Okay, Shantanu, Pranjul, let me first start by asking your growth assumptions. Shantanu, your real and your nominal GDP assumptions, and whether lately you have brought them up or down.
Hi, Lata. So we have been almost at the bottom of consensus for a while now on growth. We are at 6.1% GDP growth for the current fiscal year. We're looking at 6.3 for the next fiscal year. Nominal GDP growth in the handle of around 10%, maybe a shade higher going into FY26. It'll be slightly lower in FY25. That's sort of the broad assumptions. I think the bigger picture is that India is in the midst of a cyclical slowdown, mainly policy-driven in our view. And we can discuss if there is any policy room to stimulate the economy at all.
Okay, that precisely will be my question, but let me get Pranjal's view as well. I didn't know 6.1, Shantanu, by the way. Okay, very quickly, what's your third quarter assumption in that case?
We're at 5.9 for the third quarter. Tracking estimates are pointing slightly higher, but there's an amount of liquidity tightness that is going on in the system right now, and therefore we are not super hopeful about the recovery, at least in the first half. The second half is possible going into this year.
Okay, and I take your point. The Reserve Bank's nowcast in the bulletin was 6.2 for the third quarter, but of course the nowcast is perhaps not a very sacred number. Your thoughts, Pranjal, what are you assuming for this year and next, more important?
See, our sense is India's post-pandemic potential growth has been 6.5%. And eventually, if we get the right policy stimulus, we get there. But we may not get there in December, and we may not get there in March. Hopefully, by June, we get there. For FY26, we are assuming we get there, and we are assuming a 6.5% real GDP. But I think for the remaining 2 quarters of FY25, I think we'll probably stay in the 6.2% handle.
Okay, so for the full year, we are like 6.3 or something?
Somewhere there, yeah, 6.2, 6.3.
Okay, so between the two of you, not much, not very different as far as this year is concerned. Okay, Shantanu, because you're saying that next year, that is FY26, you're expecting only 6.3, not a big jump despite what should be a good base. You won't expect this budget to recognize that slowness and go in for more revenue expenditure rather than capital, more subsidies or transfers. Will that be a policy thrust at all?
I think there'll be recognition of the slowdown in certain pockets of the economy. We don't think this is the broad-based slowdown. Even if you look at consumption, there's an urban mass which is dragging the top end. What we are calling as affluent India is still driving growth. It's pretty good. We think that rural economy is recovering at the margin. In line with what you're saying, there are some fiscal transfers which are already happening at the subnational or the state government level. You're seeing that welfare payment, transfer payment, subsidies increase to the point of 0.5 to 0.6% of GDP over the last couple of years. Even if there's recognition, our bigger point is that you might want to shift around expenditure a little bit from capex towards welfare or transfers, but the net fiscal impulse on the economy is still going to be negative, or there's going to be a fiscal drag if you're going to consolidate the deficit. And I don't think there's any question, at least in our mind, of whether the government will be consolidating or not. I mean, there's no question of expanding deficits at this stage of the cycle.
So 4.7 or 4.8 is not at all on the cards, according to you?
Even if it is 4.7, for instance, Lata, from 4.9% of GDP this year, you're still going to have a fiscal drag because you're consolidating the deficit. So unless you go towards like 5+% of GDP, the net impulse on the economy is negative. Now, within that, we can think about the mix and whether you want to shave a little bit from capex, you want to allocate more towards welfare or transfer payments or subsidies. But overall, we think that the room to maneuver is relatively less.
Okay. Pranjal, I think you're also going with a 4.5% fiscal deficit, like many of the economists. So will there be a juggling? Will there be, letting go of this capex theme that has dominated the budget for the last 4 years? Just let go, let it fall to maybe 2.9% of the GDP or whatever, 3%, and, switch to stronger income transfers.
I hope not, actually, Lata. I do think that the government should and will stick to the fiscal consolidation path, bringing down the deficit from 4.8 to 4.4. And it's very important. Growth is slowing, but what India has right now is macro stability. Inflation is low, current account deficit is stable, and fiscal is on its way down. The deficit it's on its way down. Let's not mess that up. The cost of that would be very, very high. But within the space that you have, which is limited space, how can you best, give money for growth? And my sense is what the government has done well in the last couple of years has been capex, and I think they should not change that at this point of time. States are giving a lot of current expenditure, a lot of cash transfers. Let states run with that. I think the central government should stick to capex. Couple of reasons. Central and
but
state
they're not able to spend, no.
That was this year. It was FY25. It was an election year. We had important national elections and a very important state election. I do think that public capex comes in cycle, and we are at that point where a new cycle can start. Now, I don't think they can raise it in a very big way, but I would go with a budget estimate for capex in FY26 of about 11 trillion. What they had hoped to do in FY25, I'm hoping they at least aim to do it in FY26. And one last word. Capex comes in, state and center move together. If center starts doing more capex, states will start doing more capex. Capex gets you the jobs, it gets you in construction industry to go up, it gets you a medium-term capacity to grow. Why leave all of that? It really served us well until we were doing it, which was FY24.
I could go on a tangent and make a debate out of some of these points. A lot of capex now is prefabricated structures. Some decades ago, when Mumbai had a bridge, there would be slums that would grow. Now it is all prefab. So I don't know how capital intensive it is, and I'm not qualified to talk about that. But also capex from the states, the manner in which it is getting distributed with so many conditions, the state governments pretty much often complain. But Shantanu, what's your sense? Will the capex amount be lower than the 11 trillion or 11.111 trillion?
So we are baking in 3.2% of GDP on capital expenditure, which means that you sort of remain flat year over year in terms of percentage of GDP, which effectively means you're growing at nominal GDP growth rates, around 10%. But remember, the CAGR growth that you had in nominal expenditure on capex post-pandemic was about 25%. That gave you a fiscal boost from the capex side to the economy over the last 3 years. We've been flagging for the last year and a half that that pace of expenditure growth cannot continue. It's just a fiscal imperative or the fiscal reality that we are facing with 85% debt to GDP. And therefore, if the overall fiscal deficit consolidates and you're hitting sort of the lower bound in terms of your current expenditure, especially on subsidies, then capex will have to take a hit in terms of percentage growth rate. We still think that around 11 trillion, if they deliver, is a solid number. For India, it has multipliers. I would agree with Pranjul that this has positive multipliers for the economy, and the supply side needs to be strengthened. That's what ultimately pushes up your potential growth. But our bigger point is that in a consolidating environment to the tune of around 30 to 50 basis points on the fiscal deficit, the room to maneuver from a government is relatively less to provide a boost to the economy in terms of fiscal impulse.
Yeah, I think we all have to learn to accept that it's a very small terrain that they can really play around. But Pranjul, overall, what is the big thrust that the budget is likely to have? Will it be a big employment thrust, which was there last year? Or will it be a big housing thrust because of the multiplier that it can give? Will it be a PLI, grab this, the supply chain thrust?
I think, three broad things come to mind. I think number one, macro stability. Stick to your fiscal consolidation path and hand over the growth job to RBI. And I think RBI has the space given inflation is coming down a lot. Our January inflation forecast is 4.2%, quite low compared to 6.4 just in September. The second one, I think, is manufacturing jobs. Great opportunity. Again, supply chains could be getting rejigged this year. In Trump 1, you did not become a magnet for mid-tech FDI. Try and do that. But that will want you to be, you have to dare to be different. When the world is getting protectionist, don't increase import tariffs, actually reduce some of them. Go sign FTAs with the US and other advanced economies and let the currency be flexible. And the third one is revival of capex, because over the long term, that's the only source you have of creating capacity and jobs. Okay. So I would say these three should be the main pillars of the fiscal on February 1.
Okay. Well, Shantanu, time permitting, I'll get to the big thrust from you also. But first of all, I wanted to ask you, you've assumed a fairly strong, tax growth. I think you're assuming that the income tax, for instance, from 3.9% of the GDP, which is the revised estimate for the current year, you're expecting it to rise to 4.1%, which means you're expecting income tax to continue to grow. But when you look at the urban consumption and the other signs of slowdown, are you still enthused to assume such a strong tax growth?
As I said, consumption is not a homogeneous slowdown. Consumption, in our view, has been very heterogeneous. You're having the urban mass, which is slowing down. Some of it is driven by the macroprudential tightening by the RBI on consumer loans. Their contribution, that section's contribution to income taxes, is relatively lower. I mean, we've shown this in our budget preview that the higher income earners are contributing more and more to income taxes, and that is the section of the population which is still delivering in terms of job growth as well as income growth. I mean, services exports is one number you should look at to understand, what the kind of growth is in that segment of the population, and therefore we are pretty hopeful that we can get to around 4% of GDP on income taxes, whereas our assumption on corporate taxes is lower given the cyclical slowdown in the economy and lower earnings growth possibly going into next year.
Okay, very quickly, 10 seconds, what will be the big thrust, Shantanu?
We think that rural housing program, some credit towards MSMEs for them to kickstart the cycle of investment. Okay. And we are hoping that financing of India's green energy and energy security versus transition needs get addressed in the budget, not just in terms of fiscal allocations, but in terms of setting up the framework or the structure to carry on that investment going forward.
Okay. I'm sorry, I've just whetted your appetite. Out of time, season of earnings, you see. Thank you very much, Shantanu and Pranjul, for giving us an idea of what we should expect in the budget in terms of macros. Wrap up on Bazaar on that note. Chartbuster is coming.
Hindustan Unilever under pressure after its third quarter numbers came largely in line with very muted expectations. The company's profit after tax was boosted by a one-off gain on Pureit sales. The management expects moderation in consumption sentiment to continue.
Coforge and Persistent, on the other hand, see gains of around 10% on the back of a very good showing in the third quarter. Coforge's constant currency revenue growth comes in much higher than what the street was working with at around 8.4%, while Persistent's strong growth leads the stock higher.
Shares of Pidilite surge in trade on the back of an inline set of numbers. Total volume growth coming in closer to 10%, beating street expectations. The company says they've ramped up ad and promotion spends.
Tata Communications is under pressure despite the company posting decent set of numbers in the third quarter. Kotak Institutional Equities puts a sell call on the stock on the back of slower deal closures due to macro headwinds.
Bharat's defense surges more than 3%, now up 8% as the company signed an MOU with the Maharashtra government to invest nearly 12,000 crore rupees for an optics park project in Navi Mumbai.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam. And yesterday we saw good recovery in the later part of trade, and today we're seeing some kind of a follow-through out there as well. So Mangalam, green on the screen, the Nifty at the high point of the day. We have the weekly expiry factor as well that plays out. So the bulls will be hoping to ride on these gains.
Let's see how that goes, Nigel. You know, the ingredients